For over 100 years, the Henderson family worked the same piece of land in rural New South Wales. But today, their children can't afford to buy it. This is the story of how Australian ranchers are being priced off their own land, and why the nation's food security depends on stopping it. Imagine inheriting not just memories, but a livelihood. A place where your grandfather planted his first crops, where your father raised cattle through droughts and floods, where you've spent every dawn and dusk understanding the soil beneath your boots. Now imagine being told you can't pass that legacy to your children because the price tag has become impossible. This isn't just happening to one family, it's happening across Australia, and the numbers tell a stunning story of a nation in the midst of an agricultural crisis. We need to start with the numbers because they're almost unbelievable. 15 years ago, a hectare of Australian farmland cost around $5,000. Today, that same hectare costs nearly $11,000. Some places are far worse. In Victoria, you're looking at $14,800 per hectare. In Tasmania, it's over $18,000. This isn't gradual inflation. This is a tripling of prices in just over a decade, roughly 201% growth. A family farm worth $500,000 in 2010 is now worth $1.5 million. Sounds great if you already own land, right? But if you're a young person who loves agriculture and wants to continue your family's tradition, it's become a financial impossibility. The real crisis is the gap between what the land is worth and what you can actually earn from farming it. A young farmer in New South Wales told us that good arable country costs over $14,800 per hectare. Think about that for a moment. If you're starting out, if you have the passion and the knowledge and the willingness to work 18-hour days, you simply can't get in the door. Unless your family already owns land, unless you have wealthy investors backing you, or unless you're willing to go into debt that would bankrupt most people, farming has become an exclusive club reserved for those who already have money. The Henderson family bought their first property 70 years ago. It was a substantial investment at the time, but it was achievable through hard work and careful management. Over the decades, they expanded, improved the land, built infrastructure, and created a thriving operation that supported multiple generations. The land became productive, not just because of its inherent qualities, but because the Hendersons invested their labor, knowledge, and resources into making it work. Now their eldest son wants to take over. He's been working on the property since childhood. He knows every paddock, every water source, every seasonal challenge. He's ready to commit his life to continuing what his family started, but the land is now worth $8 million. His parents could sell it to a foreign investment company or to one of the mega corporations expanding their holdings, and they'd make a fortune. But then what? His son would need a mortgage he could never service. This is the brutal mathematics of Australia's agricultural crisis. Land value has become decoupled from productivity. You're not buying farmland based on what you can earn from it anymore. You're buying it because land is considered a safe investment, because wealthy individuals and foreign entities see it as a store of value, and because there's limited supply driving prices up. This is driving out the people who actually want to farm. Between 2020 and 2023, Australian farmland values grew by 79%. That's extraordinary growth. Commodity prices improved in many sectors. The livestock market saw a sharp rebound in late 2023 and into 2024. Demand for beef from China remained strong. These are genuine economic factors that should support land values. But they don't justify an 80% increase in 4 years. The real drivers were different. Interest rates were historically low. Money was easy to borrow. People who had capital wanted to put it somewhere safe, and agricultural land seemed like a secure bet. Investment funds, wealthy individuals, and foreign entities all piled in. Supply was limited because existing farmers weren't selling. They were holding onto their land. This created a classic supply and demand squeeze that pushed prices to levels that have almost no connection to agricultural productivity. Then something changed. In 2024, the growth cooled. Farmland prices rose only 2% for the year, compared to growth rates of 25% in 2021 and 2022. The national median price even declined slightly by 6%, with grazing land particularly hard hit, dropping 13% in a single year. What happened? Interest rates went up. Borrowing became expensive. The easy money dried up, and suddenly the emperor had no clothes. The prices that the market had enthusiastically bid up just months earlier started to look unsustainable. But here's the critical detail. Even though prices have cooled, they haven't crashed. And they're not going to crash back to levels that young farmers can actually afford. The national median is still just under $11,000 per hectare. Victoria is still at $14,800. Tasmania is still at $18,000. These are extraordinary prices for land that, in many cases, can only generate modest returns for farmers actually working it. Land transactions have collapsed dramatically. In 2021, there were over 10,500 sales of agricultural property. By 2025, that number had dropped to just 5,408. That's a 50% decline from the peak. What this tells us is that many farmers and investors have simply withdrawn from the market. Sellers are holding onto their land, hoping prices recover. Buyers are waiting on the sidelines, unable or unwilling to pay the asking prices. It's created a kind of market paralysis where prices remain stubbornly high, but almost nothing is changing hands. Young farmers are watching their dreams slip away. Ben Walker, a young farmer at Cumnock Farm in New South Wales, was explicit about the problem. He said young people want to get into farming, but land in his area is over $6,000 per acre. That's $14,800 per hectare. People can't afford it unless they have massive financial backing, or they've got land in the family they can start with. Those are the only two ways in now. And that means an entire generation of talented, motivated, educated young people is being locked out of agriculture. This creates a vicious cycle. As young farmers are priced out, the average age of farmers keeps climbing. The median farmer in Australia is now between 53 and 59 years old, compared to the median age of 40 for the rest of the workforce. Within the next 15 years, many of these farmers are going to retire or pass away. Who's going to replace them? If we've priced out an entire generation, if young people can't afford to buy or even lease land, we're heading toward a catastrophic workforce shortage in agriculture. Australia's agricultural sector is worth over $100 billion annually. It's one of the world's largest food exporters. The nation exports about 60% of its agricultural products. Australia has a food trade surplus worth billions of dollars. But all of that depends on having people willing and able to farm. If we've made it financially impossible for the next generation to enter the industry, we're not looking at a rural problem. We're looking at a national food security problem. Input costs have become astronomical. We're talking about fertilizer, fuel, equipment, and labor. A farmer described to us what's happened with fertilizer. Just a few years ago, it took about 1.8 to 2 tons of wheat to pay for 1 ton of urea. Today, that ratio has doubled. You now need 4 tons of wheat to pay for 1 ton of urea. This means that even if a farmer can physically obtain fertilizer, the margins have been entirely consumed by input costs before the first crop is even harvested. The profit has been squeezed out of the equation completely. Australia has some of the most ancient and nutrient-deficient soils on Earth. Unlike other major agricultural nations, Australian farmers can't just rely on inherent soil fertility. They need significant fertilizer applications. Without phosphate-based starter fertilizers, Australian crop yields could collapse by 40%. So farmers aren't choosing whether to fertilize, they have to fertilize, which means they're forced to accept margins that are now being compressed to the breaking point. Climate is adding another layer of stress. Australian farmers face increasing climate volatility. There are harsher fire seasons, more ocean heat waves, sea level rises in coastal areas, and increasingly severe droughts in some regions. Barris research shows that climate change is costing Australian farmers an average of $30,000 per year in losses and additional management costs. For many operations, that's enormous, and it's only getting worse. A comprehensive survey of Australian farmers asked them to identify their biggest challenges. 57% cited economic conditions, including inflation and prices, as their primary worry. That number has been climbing steadily. Just a few years ago, it was only 35%. Now it's 57% and climbing. 23% identified government policy as their biggest concern, and that's also doubling year after year. Staffing issues and labor shortages came third, mentioned by 18% of farmers. This tells us something important. Farmers can adapt to climate challenges. They've always done it. But the economic squeeze, land prices, input costs, commodity market volatility, interest rates, that's existential. That's what's breaking them. Commodity prices have been volatile and often disappointing. Grain prices softened in 2024 and into 2025. Dairy prices dropped, cotton prices fell, sugar prices declined. Each of these declines individually would be manageable, but combined with high interest rates and elevated fertilizer costs, they've created a perfect storm. Margins have collapsed. Farmers who were optimistic just a couple of years ago are now running operations with almost no profit, or in some cases, they're operating at a loss and hoping things improve next season. Now let's talk about something that's been adding fuel to the fire. Foreign investment in Australian agricultural land has been steadily increasing. As of mid-2025, foreign entities control over 50 million hectares of Australian agricultural land. That's 13% of the nation's total agricultural area, and it's been growing. The Northern Territory has the highest concentration, with foreign investors controlling 27.8% of agricultural land there. Queensland has the largest absolute area, with foreign investors holding over 17 million hectares. Interestingly, the countries involved vary. The United Kingdom is actually the largest foreign owner of Australian farmland, followed by the United States, the Netherlands, Singapore, and China. But China has been particularly notable because of the political and media attention. If the Australian government hadn't blocked a proposed sale of S. Kidman and Company, one of Australia's largest cattle operations, to a Chinese company back in 2014, China would now be the second largest foreign landowner. 87% of foreign-held land is used for livestock operations. That suggests foreign investors aren't necessarily looking to optimize agricultural production. They're looking at land value appreciation and carbon credits from livestock operations. They're treating agricultural land as a financial asset, not as a productive enterprise. This is a fundamentally different relationship to the land than what family farmers have. When foreign entities control land, several concerns arise. There's the question of food security. If a foreign government or foreign company controls productive agricultural land, they might prioritize export back to their own nation over domestic food security. There's the question of expertise and sustainability. Family farmers have generations of accumulated knowledge about their specific land and region. Distant investors don't have that. There's the question of profits from agriculture on foreign-owned land flow out of Australia to foreign investors. But here's the thing. Foreign investors aren't the primary force pricing out Australian farmers right now. That's a convenient narrative, but it's not the central problem. The bigger issue is Australian investors, individuals, investment funds, superannuation funds, corporate farming operations, who are all treating land as a financial asset rather than a productive resource. A young farmer can't compete with an investment fund that's willing to pay premium prices because they see long-term appreciation potential. A family farm operation can't compete with a large corporate farm that has access to capital markets and can bid aggressively for land. The market has fundamentally broken down. We've created an economy where the highest price wins, and the highest prices are being paid by people who aren't farming the land. They're just holding it, betting that it will appreciate. Meanwhile, the people who actually want to work the land, who have the expertise and the passion, can't afford to compete in this market. Regional variations tell an important story. Western Australia has seen strong growth, with prices jumping 18.7% in 2024, reaching $9,635 per hectare. But New South Wales experienced a sharp correction, down 24.4%, wiping out much of its recent gains. These aren't random fluctuations. They reflect different economic conditions in different regions, different commodity complexes, and different investment pressures. Western Australia has benefited from strong demand in Asian markets and export terminals. New South Wales, with its more diverse agricultural base, has seen weakness across multiple commodities simultaneously. The market outlook for 2025 and 2026 is mixed. The consensus among agricultural economists is that we'll see modest growth, nothing like the 25% annual increases of 2021 and 2022. Interest rates are expected to remain elevated. Commodity prices face uncertainty from global trade tensions and market dynamics. Seasonal conditions are mixed across the country. The supply of available farmland remains tight. Buyers are searching for value, and sellers are reluctant to accept anything less than their asking prices. In dairy and beef, the outlook is reasonably positive. China's appetite for Australian beef remains strong. U.S. import levels are at record highs. These are bright spots. Canola production is potentially heading toward the second largest crop on record, with Australia having resumed exports to China after a 5-year hiatus. But grains and oilseeds face headwinds from tariffs and declining global wheat stocks. It's a mixed picture that doesn't inspire confidence that farm profitability is about to surge. We've reached an inflection point. For years, land prices could climb because commodity prices were strong and interest rates were low. Now, neither of those conditions holds true. Prices have cooled, volume has crashed, but prices haven't reverted to levels that make economic sense for farmers. They're stuck in this uncomfortable middle ground where they're too high to attract new entrants, but not low enough to trigger a panic sale or a major correction. Some farmers are finding creative solutions. Younger farmers who want to stay in agriculture are diversifying into agritourism. They're adding experiences, farm stays, farm-to-table restaurants, educational programs, to create additional income streams that don't depend on rainfall or commodity prices. These initiatives often help keep family farms viable, but it's a patch, not a solution. You can't solve the structural problem of unaffordable land through agritourism. Others are looking at leasing arrangements rather than purchasing. If you can't afford to buy land, maybe you can lease it from someone who owns it but doesn't want to actively farm it. This is a legitimate model in many agricultural systems, but it has its own challenges. Lease rates need to be attractive enough to compensate the landowner, which means they're also often too high for a young farmer to make a profit. And you never own the asset, so you can't build equity or use it as collateral for other investments. The government has recognized the problem, though policy responses have been limited. There's a future drought fund that's invested $5 billion Australian dollars aimed at strengthening drought resilience. That's helpful, but doesn't address the land affordability crisis. Foreign investment in agricultural land requires approval if it exceeds $15 million in cumulative holdings. which is meant to protect Australian control of agricultural assets. But it hasn't slowed the trend of foreign investment in meaningful ways. State governments have dabbled with various incentive programs, but nothing comprehensive has emerged. We need fundamental rethinking of how we view agricultural land. Is it a productive asset, or is it a financial asset? If it's productive, then we should be prioritizing policies that keep it in the hands of people who can and will farm it. If it's financial, then we should expect young farmers to be priced out and accept the consequences. Right now, we're trying to do both, which satisfies neither goal. Some advocacy groups have suggested that governments should prioritize land access for young farmers and established farmers over investment returns for outside capital. There are models from other countries worth examining. Denmark has traditionally given preference to farmers purchasing agricultural land over investment entities. New Zealand has restrictions on foreign ownership. Ireland has programs specifically designed to help young farmers access land. None of these solutions are perfect, but they represent different philosophical approaches to treating agricultural land as something special. Existing landowners benefit enormously from the current system. They've seen their assets appreciate dramatically. Politicians depend on donations from wealthy individuals and corporate interests who benefit from the current system. These are real interests that would be threatened by policies designed to make land more affordable for young farmers. But there's a counter-interest that's rarely quantified in the political debate. Food security is a national security issue. Workforce development is an economic priority. Rural community viability is social infrastructure. These are long-term national interests that should count for something in the policy debate. Right now, they're being drowned out by the short-term interests of existing stakeholders who benefit from expensive land. Australia has positioned itself globally as a reliable food exporter. In uncertain times, when global food supply chains are fragile and geopolitics are volatile, Australia's agricultural productivity is increasingly valuable. But that productivity depends on having a skilled, motivated workforce. It depends on having systems where people who are good at farming can actually do it. Right now, we're building barriers to entry that are pushing out exactly the kind of people we need. Young farmers who are being priced out have often received agricultural education. They're trained in modern farming practices. They understand technology, data, and sustainability. They're exactly the kind of people who should be leading Australian agriculture into the future. But instead, they're being forced to choose between impossibly high debt loads or leaving the industry entirely. Many of them are choosing to leave. They're moving to cities, taking jobs in other sectors, abandoning expertise that took years to develop. From a national perspective, this is a massive waste of human potential. The story of the Henderson family is being repeated thousands of times across Australia right now. Families are making difficult decisions about whether to sell to outside investors and ensure their retirement, or to hold onto the land and hope their children can somehow figure out how to make it work financially. Most are choosing to sell. That's not a moral failing. That's a rational response to economic conditions where holding land as a family enterprise no longer makes financial sense. This isn't a uniquely Australian problem. Rural areas in many developed nations are facing similar challenges. Land has become financialized. Prices have decoupled from productivity. Young people are being priced out. But Australia's situation is particularly acute because agriculture is such a significant part of the national economy and the national identity. We're a food exporting nation. Our agricultural sector is a huge source of export revenue. We can't simply accept that we're losing the ability to produce food competitively. The question facing Australian policymakers is whether agricultural land should be treated like any other real estate asset, subject to free market forces, and available to whoever can pay the most, or whether it should be treated as a special kind of asset worthy of government intervention to preserve food security, support rural communities, and enable young people to pursue careers in agriculture. Right now, Australia is doing neither successfully. The market is broken and policy hasn't stepped in to fix it. What might a solution look like? It could include government-backed loan programs specifically for young farmers, making capital cheaper and more accessible. It could include land grants or purchase assistance programs. It could include preferential purchasing rights for established farmers when land comes to market. It could include restrictions on foreign ownership or corporate consolidation of farmland. It could include tax policy changes that discourage treating land purely as a financial asset. Different countries have tried different approaches with varying degrees of success, but any solution requires acknowledging the problem first. And for too long, policymakers have been in denial. They point to statistics showing that about 99% of broadacre and dairy farms are still family-operated. They note that only about 0.1% of non-family-run farms are foreign-owned. These statistics are technically true but deeply misleading. Yes, the vast majority of farms are still family-operated, but the family farms are being squeezed. They're not thriving. Their profitability is declining. Their average operator age is rising. Their ability to attract the next generation is collapsing. Real metrics we should be tracking are different. What percentage of farms are operated by people under 35 years old? That number is declining. What's the average debt-to-equity ratio on farms? That's rising, indicating farms are increasingly mortgaged. What percentage of farm operators are planning to pass their farm to the next generation? That number is plummeting. What percentage of agricultural land is controlled by non-farming investors? That number is rising. These are the metrics that should inform policy. The Henderson family, and thousands of families like them, are facing a choice that should break your heart. They can work the land they love and watch their children leave for better economic prospects. Or they can sell to an outside investor, lock in financial security for their retirement, but end a centuries-long tradition of family farming. These shouldn't be the only options available to people who've built productive enterprises and want to pass them to the next generation. Australia is at a crossroads. The nation can continue on its current path, allow market forces to concentrate land ownership among investors and corporate operations, watch the next generation of farmers drift away, and hope that corporate agriculture can maintain food productivity and export competitiveness. Or it can acknowledge that agricultural land is special, that food security matters, that enabling young people to pursue agriculture is worth doing, and implement policies to support those values. The choices we make in the next few years will determine whether Australian agriculture remains a source of national strength or becomes a cautionary tale about what happens when you let market forces concentrate control of essential productive assets. The story of the Henderson family isn't over yet. They haven't decided what to do with their land, but they're running out of time. Interest rates remain high. The market remains uncertain. Each passing year makes it less likely that their son will be able to make the numbers work. So they're watching the market, waiting to see if conditions improve, hoping for some policy shift that would make succession possible. They're not alone in waiting. Thousands of families are in the same position, making the same calculations, wrestling with the same impossible choices. This is the real story behind Australian ranchers being priced off their land. It's not just about numbers and statistics, though those are important. It's about values, about whether we believe that agricultural knowledge should stay in families that have built it over generations, and about whether young Australians should be able to pursue careers in farming, about whether food security is something a nation should actively protect or simply hope for. These are the questions that matter, and they deserve serious attention from policymakers and citizens alike, because if we get this wrong, the price won't just be paid in dollars. It'll be paid in lost expertise, lost opportunities, and a fundamental shift in who controls Australia's food supply.